So the dollar could lose 90% of its value, not in 100 years, but in a decade. And so what's going to happen to the price of gold in that circumstance? It's not going to be 2,500, it'd be 25,000. And that's just 90%, not 99%. Then you'd have to add another zero, 250,000. I don't know that it's going to get that bad. But if we end up with hyperinflation, it will get that bad. We just don't know yet how bad the inflation is going to be before the politicians finally and reluctantly do the right thing. But it's going to be a lot worse than it is right now. And so that means gold and silver prices are going to be much, much higher. And so people should act now to get rid of their fiat currency and buy gold and silver. Not because it's an investment, but because it's a form of savings.
After two steep rallies in gold and silver from the end of February to mid-April and the beginning of May to May 21st, the gold and silver prices corrected to 6% and 10% respectively. While the dollar has lost 87.5% of its value versus gold since 2000, using $300 as the benchmark for the gold price. Currency devaluation is the most significant factor driving the price of gold. David Schiff is an American stockbroker and a key figure involved with Euro-Pacific Asset. While illustrating a 99% loss in the dollar's value since the Federal Reserve's creation, PeterSchiff highlights that gold was $20 an ounce in 1913, but today it takes $2,500. He warns that the dollar could lose 90% of its value within the next decade, potentially driving gold prices to $25,000 per ounce. The shift from dollars has also been pronounced in countries concerned about U.S. financial sanctions, like Russia and China, and dollar hegemony. Such central banks have also increased their holdings of gold, though gold remains a small percentage, about 10% of overall central bank reserves. Regarding wealth preservation, Peter advises converting fiat currency into precious metals, as they protect better against inflation than low-interest cash. He believes holding gold and silver is more prudent when assets like stocks or real estate seem overpriced. From 1973 to 1979, gold won over many investors as a top inflation hedge since the yellow metal generated an impressive 35% annual return. While the 1970s played a big role in giving gold a shining reputation as an inflation hedge, its performance since that time has been lackluster. With all the macroeconomic factors in play, Peter anticipates the Dow Jones could fall below 2 ounces or reach parity with gold, as seen in 1932 and 1980. He predicted the Dow could hit 20,000 while gold reached 10,000, or both could climb to 100,000. Now we present the clips of Peter Schiff's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
When the Federal Reserve was first created in 1913, you only needed $20 to buy an ounce of gold. Now you need $2,500 to buy an ounce of gold. The dollar has lost more than 99% of its value ever since we turned it over to the Fed. But if you go back to when the Republic was started in 1789, when we ratified the Constitution, you needed $20 to buy an ounce of gold in 1789. And in 1913, it still was $20 to buy an ounce of gold. So our money had stable value. In fact, it increased in value. Prices were half and the dollar maintained its value, actually became more valuable. But ever since we turned it over to a central bank, the dollar's been destroyed. But I think what they did in 100 years, they may do in another 10 years. So the dollar could lose 90% of its value, not in 100 years, but in a decade. And so what's going to happen to the price of gold in that circumstance? It's not going to be 2,500, it'd be 25,000. And that's just 90%, not 99%. Then you'd have to add another zero, 250,000. I don't know that it's going to get that bad. But if we end up with hyperinflation, it will get that bad. We just don't know yet how bad the inflation is going to be before the politicians finally and reluctantly do the right thing. But it's going to be a lot worse than it is right now. And so that means gold and silver prices are going to be much, much higher. And so people should act now to get rid of their fiat currency and buy gold and silver. Not because it's an investment, but because it's a form of savings. It's a way to protect your purchasing power. It's better than keeping your money in cash. Even if that cash pays a small amount of interest, it's still not enough to offset the inflation. So it's still a negative interest rate. And so a zero interest rate on gold is better than a negative interest rate on cash. And, sometimes if you think that assets are too expensive, if the stock market is high, if real estate is overpriced, and you want to have dry powder, it's much better to keep your dry powder in gold and silver than in a fiat currency, because it's possible that when you need the dry powder, your fiat currency is going to be all wet because inflation is going to destroy it. I mean, even if asset prices come down, they may not come down in terms of dollars or euros, but they really could come down a lot in terms of gold, which is what I expect. I expect ultimately we're going to have deflation. The government is doing everything it can to prevent assets from deflating, but it won't work. Prices will deflate, just not in their fiat currencies. They can control that. They can make sure that prices always go up in the currency that they create, because that currency has no real value and they can create as much of it as they want. But what they can't prevent is prices from collapsing in terms of real money that they can't create, which would be gold and silver. And so that's what people should be holding if you are hoping to take advantage of a bargain, of a fire sale on assets, and you want to have the ability to buy them. The money you should be saving is gold and silver, because that will put you in a much better position, because you're going to see huge declines in prices measured in precious metals versus increases in fiat currencies. You know, if you look at the Dow Jones right now, it's at about 16 ounces of gold. My forecast is for the Dow to be below 2 ounces of gold. I think somewhere between 2 ounces and 1 ounce. But, you know, and that's historically precedent. You had that in 1932, you had that in 1980, 82 time frame. So I think it will happen again. It happened twice last century. And, you know, the Dow was 20 ounces of gold in 1929, and then it went to 1 ounce, 1932. It was back over 20 ounces again in 1966, and then it went back down to almost 1 ounce in 1980. We got up to 42 or 43 ounces in the year 2000. That was an all-time record high. But, you know, gold over the last 23 years is up more than 8-fold, whereas the Dow was only up 4-fold. So the Dow has lost half its value priced in gold so far, you know, this century. But we're still at about 16 ounces.
During the interview, Peter Schiff mentioned that markets might react poorly if the Fed doesn't cut rates in September, since they expect a cut. He predicts that a cut is likely, but argues that the Fed should raise rates instead. Enthusiasm over a likely interest rate cut by the U.S. Federal Reserve in September propelled bullion to an all-time high of $2,509.65 on Friday. This, coupled with increased geopolitical tensions and robust central bank buying, has sent bullion over 20% higher so far this year. Furthermore, Peter pointed out that gold's rise to $2,500 signals an overly loose Fed policy, echoing Alan Greenspan's use of gold as a guide. He notes the weakening dollar will raise consumer prices and concludes that the Fed's rate cuts are a surrender to economic pressures, leading to worsening inflation. Let's get back to the interview.
Well, I think if they don't cut rates in September, the markets may not like that, because they're pretty much pricing in a cut, which is why I expect the cut to happen. The question is, are they going to go 25 basis points, 50 basis points? That's kind of where we are. But the broader point is that they shouldn't be cutting rates at all. In fact, not only should they not be cutting rates, they should be raising rates. They stopped raising rates too soon. Monetary policy never really became restrictive the way they claim. And the reduction that we've had in the official measures of inflation is only temporary. And I think that these rate cuts that are contemplated and will probably start in September will be the catalyst to cause inflation to rise to new highs, at least the way it's measured by the CPI. You know, the Fed claims that it's data dependent. Well, the most important data point when it comes to monetary policy and whether you're too loose or too easy is gold. And in fact, Alan Greenspan, who used to be the Fed chairman, when he was asked about it, he said that he uses gold. And at the time, gold was around $350 an ounce when he was answering this question before Congress. And he said, well, if I see the gold price up about 400, I know that I'm too easy. And if the gold price goes below 300, I know that I'm too tight. So he said, we're not officially on a gold standard, but unofficially we are, because I use gold as a guiding, a light to set policy. So I know if we're too easy or too tight. Well, by that, data point, gold's at 2,500. Gold's at an all-time record high. Gold's moved up 25% so far this calendar year in anticipation of the Fed cutting rates. Well, what does that tell you? That these rate cuts are a mistake. That is the data point that the Fed should be looking at. Also, look at the dollar, which hit a new 2024 low this week. It's now back to where it was in December of 2023. But what's more important is the trajectory. The dollar is falling, and it looks like it could fall substantially again, this is the currency market saying you're making a mistake, because the weak dollar in and of itself is going to push up consumer prices because we buy stuff with dollars. America has a $1 trillion a year trade deficit. We import all sorts of products that we pay for with dollars. Well, if the dollar goes down, the price of all those products has to go up by definition. So the Fed is about to make the inflation problem worse by claiming that it solved it. Right? So they're actually not cutting rates because they won the inflation war. They're cutting rates because they lost. It's a surrender, because they're looking at the impact that the higher interest rates are having on the economy, on employment, which is something that has to happen, because the low interest rates is the artificial support that boosted the economy. It created based on debt. And so when you raise interest rates, you make that debt that was accumulated when rates are low a big burden on the economy. So there's no way to normalize interest rates without collapsing the artificial economy that was built on top of the cheap money. But now the Fed doesn't want that to collapse, so it has to go back to the cheap money, which means we're going to get a lot more inflation.
Currency devaluation and physical demand are the biggest factors pushing gold and silver higher. Growing global geopolitical instability and increasing U.S. political instability are also stimulating gold's haven appeal. Do you believe that gold will continue to rise as a safe haven? Or will other assets emerge as better options for protecting wealth in the coming economic environment? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.